Shares of Lyft popped in the after hours on Tuesday, February 9th because it reported its fourth quarter earnings. Let's take a look at the report and if it belongs in your portfolio. Here are some of the key numbers out of Lyft's report. They reported a loss per share of 58 cents versus the estimated 72 cents. They beat on revenue at $570 million versus the estimated $563 million. They missed on active riders while only reporting 12.55 million riders versus the estimate of 13.2 million riders. But their revenue per active rider actually beat at $45.50 versus the average of $42.20. Now let's break down some of those numbers. Their loss per share was a fairly big beat at 14 cents. And for those of you unaware, Lyft is not profitable at the moment. But based on this beat as well as other analysts' expectations and estimates, they will be profitable or should be profitable by this time next year. They did miss on active riders. However, I think we're going to give them a pass on that one since it's a pandemic and all that fun stuff. Like, I don't really know. Like, yes, I'm aware that that's a key metric for this company because that's what they do. Currently, we're in unprecedented times with a pandemic. No one's really going anywhere. I think we're going to put that one on the back burner. We're definitely going to look at it for future earnings reports. But for this one, I'm just going to shove that one under the rug. The company did come out and say that demand was negatively impacted due to a surge of coronavirus cases and efforts to try and slow down the virus. The company has failed, however, in its ability to bulk up in additional segments like its main competitor, Uber. In an effort to replace lost revenue from the pandemic, Uber focused on food and its delivery segments with Uber Eats. Lyft has yet to grow into a delivery business. The company did say last quarter that it is working on expanding into the delivery service by consulting with restaurants as well as retailers. Lyft lacks revenue streams outside of ride-sharing and is only operable in North America and has struggled because of the United States' inability to contain the virus. The stock has returned to pre-pandemic highs of around $53 to $54, so good job. Now let's take a look at what some of the analysts have to say about the stock. If we take a look at what the analysts were saying 3 months ago about Lyft, 24 of them had buy ratings, 14 had holds, while 2 of them were selling with an overweight consensus. Whereas today, it's pretty much unchanged. The average price target on Lyft is $49.71, while at the time of this video, the stock price is around $53. So it's pretty much exactly where the analysts want it to be. The highest price target for Lyft is $70, while the lowest price target is $10. And if we look at the 6-month chart on Lyft, the past 6 months, it is up 72%. However, looking at the 12-month chart, it is in the red, being down 0.15%. Now, obviously, that is almost entirely because of the pandemic, but after these earnings, it seems to have gotten back to its pre-pandemic highs. At the end of the day, if you want to invest in some sort of ride-sharing business, you pretty much only have 2 options in terms of Lyft and Uber. Now, obviously, I cannot sit here and tell you which one to buy. I am in neither of them, full disclosure, but if you prefer one or the other, let me know down in the comments below. Are you currently holding Lyft or Uber? Are you planning on getting in? Let me know. As always, feel free to like and subscribe. Thank you for watching, and I will see you next video.